All right, so we're going to run through how I analyze small multifamily properties on this calculator. As you get started with real estate investing, running the numbers on the property is probably going to be the most important skill that you're going to need to get under your belt and get familiar with. Because at any point in time, there's hundreds of properties in the market that you could buy, but how are you supposed to tell the difference between property A and property B and what's going to be more profitable for you long term? Once you're running the numbers on it, right, and calculating it to make sure that the returns that you're getting out of the property make sense and are going to be profitable for you long term. So we'll run through this. Really, it's a very basic calculator. There's hundreds of them out there. You just got to find one that you like. I like this one because you can do it very quickly, a couple minutes, and it gives you the very couple key KPIs that I think are important when looking at investment property. There's a downside with this. The downside is that it is a snapshot in time, meaning that it is taking your income that your rents are currently, the expenses that they are currently, and your debt that it is currently, and showing the KPIs. It doesn't show that what that looks like extrapolated out in 5 years or 10 years. And as we know, beauty about real estate is over time, your income continues to go with rent growth, your expenses go up a little bit with inflation, but typically they're higher the first year. And then as you stabilize a property, go through and get work orders completed and things like that, your expenses stabilize and then just go up with inflation from there. And then your debt is locked in, right? 30-year fixed rate debt, or maybe you're doing a 25-year 5-year AM, but for the most part, your debt is locked in at a rate that you're familiar with. That doesn't go up, right? It's not, most people aren't buying variable rate debt, so, or variable rate loans. So the better way of saying that is this is probably the worst your investment property will ever look over the life of owning it, and that it only gets better from here as the rents continue to go up, your debt stays the same, and your expenses stabilize. So but there's two columns here, column B and column C. They are basically mirror, and the only time I ever use column B is if you are looking at a property that has leases that are, say, locked in for 8 to 12 months. And the reason that is because you can't change when you buy a property; those leases come with it, right? So if you got two units, you're analyzing a duplex and they're locked in for 8 to 12 months. You've got to ride those leases out until you can make any changes. So if they're way below market, or if they're way below what you would rent them for, it doesn't matter. You got to ride those out. If you're buying them today, you got to ride those out for the remainder of those leases until you can make any changes. Most properties on the market and off market are going to be month-to-month leases, so you can come through and pretty quickly get those up to market rents. So that's why I usually only analyze properties with column C, and usually this is hidden. But so we'll run through this calculator. The calculator is going to take 3 main inputs. You guys have probably heard me say this before, but real estate is really simple. It's income, expenses, and your debt. If you can figure those 3 things out, you can figure out with a reasonable expectation how profitable your property is going to be, right? So starting from the top here, just enter your purchase price up here, and then your down payment over here. So 20 to 25% if you're non-owner occupying. If you're owner occupying, a lot of you guys know you can get in for 3.5% or 5% down. So just put that there, and then your annual taxes there, and then how many units. Is this a 2, 3, or 4 unit property? Put that in there. From there, it's going to calculate your down payment, your closing cost estimation, and then the seller credit is likely going to be something that you'll input after you put an offer on the property, because it's not something you're going to know upfront. You can estimate, depending on the market that you're in, potentially a % or 2 of seller credits. In this market that we're in right now, spring of 2023, it's not uncommon for us to get a % to 2, sometimes 3% seller paid closing costs or seller credits in there. So you could, in this, for example, you could put $4,200 and pretty safely say that you're going to get that. Of course, if it's multiple offer situation and there's 5 offers on the table, well, don't expect to get that. But as far as upfront repairs, if you've gone and gotten bids for something, you could put that in there. If you're not, and you're walking into a turnkey property, or you're walking into just a cosmetic value add, you can ballpark this pretty easily. No matter what, I always like to put at least $3,000 to $4,000 in here, because even if you're buying something turnkey, you do your full inspection, you do everything that you possibly can, there's always something that comes up. So it's good to have some sort of reserves on a property and account for at least a couple $1,000 that you might pop up, over the first month or 2. All right, then it spits out your total out-of-pocket costs. So what you can expect to have to front when you go to close this property. and that's your down payment, your closing cost, and any upfront repairs. So check, small correction, your upfront repairs obviously won't have to be paid at closing, but if you're going to do the renovation shortly after, you want to have those on hand. All right, so then you go into your income. So unit 1 through 4 here, if it's a duplex, you'd only throw these first 2 units in there. And how to get those rents. There's a bunch of different ways to estimate rents, and it's a little bit more of an art than it is a science. I use Rentometer because it's a pretty good aggregation of a bunch of different rental listings in a certain area. So you can see this fourplex that we're analyzing for a client. Just enter in the address here, whether you got 2 beds, 3 beds, 4 beds, and then you can kind of see what the average and the median and the lower end and the top end of the rental ranges are, and then you can see trends as well. As far as what you plug in, you're gonna be super bullish and put in the 75th percentile. You're gonna be super conservative and put 25th percentile. I'd go a little bit towards the high end. The reason being is because between your median rent and your 75th percentile is usually where I land. And the reason I do that is because over the years of owning properties and helping clients get into properties, I've found that getting to that 75th percentile, there's a few things, relatively cheap things that you can do to your property. Things like updated light fixtures, things like LVP, which you can get at this point in time, you can get installed for $4 a square foot, so it's relatively cheap. Paint jobs, these are really minor things that update your property and make it a little bit more modern that will get you to that 75th percentile. Adding a dishwasher, huge for rentals in this area. In unit laundry, if you've got any sort of those things, you're going to be able to get up close to that 75th percentile. And the other side of it too, I found it's more about marketing than it is about your property. So if you are halfway decent at marketing, or you get halfway decent property manager, then you're going to be able to get a 75th percentile. So if you're just one who's throwing your rentals up on Craigslist and that's all you're doing, you're probably not going to get the max rents. But if you're on Zillow, if you're on apartments.com, if you're on Craigslist, if you're on Facebook Marketplace, if you're distributing your listing for your vacancy out to many sites, then you're going to, with good photos and with good descriptions and things like that, that alone is going to get you a bump in rents over the person who's just throwing it on Craigslist Marketplace Craigslist, or putting a sign in the yard. So there's sites that do that for you very cheaply, where you can just plug the information at once and it syndicates it to all these different sites on the internet. Or if you got a property manager, they can help you out with that. But long story short, there's a few really basic things that you can do with your property with some minor cheap updates. And then there's really easy marketing that you can do to make sure that you get that 75th percentile rent. So, all right, so you plug in your income here. If you've got a 3-1 and a 2-1, obviously you're going to want to comp those rents specifically, a little bit more in depth and not just a blanket approach. And then your other income. So other income, for simplicity's sake, you just estimate $50 per unit. $25 per unit in each one of these categories. It's likely a little bit more than that, but just to be conservative, you throw it on the lower end. I find that you get anywhere from about 8 to 10% of your rent roll. So 8 to 10% of your total rental rates in additional income if you're doing it right. So that could be anywhere from pet fees, move-in fees, RUBS, which is billing back for utilities. There's a whole slew of other fees that typically come with owning a rental or other income, laundry income, parking, got a garage, you want to rent it out, whole slew of different things. But just to be safe, you can estimate $25 per unit in each one of these categories for other income. Vacancy, you always want to estimate vacancy. Market vacancy is at this point in time, is anywhere from about 4.5 to 6, depending on what part of the market that you're in. This is also one of those things with good management. You can, I won't say eliminate, but you can get very, very close to eliminating this. So when I had small multifamily duplexes and things like that, I would have somebody move out on the 31st. They had to move out by noon. I would have my cleaning crew, my handyman, and everybody kind of lined up that day. We would knock out a few hours of work, and then people would move in the next day on the 1st. And that starts really way before that moving day. So as soon as somebody moves out, they've got to give 60 days notice on my leases. which gives me plenty of time to get in there, make a checklist of things that need to be done, make sure any parts are ordered, take pictures for updated marketing, and market that property and get it pre-leased before that person even moves out. You don't want to have somebody move out and then start the process right then, because you're going to be months before you get somebody to actually move in. But regardless, you still want to underwrite or estimate with some vacancy, because ultimately at some point in time over the ownership, you're going to have it. And it market-wide averages anywhere from 4 to 6%. And that is already calculated in here. So it just takes it off your gross rents. Property taxes, just going to split, put here, and it's going to split it monthly for your costs. Insurance, 100, 150 bucks for most of these duplexes to triplexes. Obviously that's going to range pretty broadly depending on who you go with and the coverage you go with. So it's hard to estimate that if you're very specific about your insurance, but for run-of-the-mill insurance, 125 bucks to 135 bucks a month is plenty to cover that. Repair and maintenance, this is one of those ones where it's just an estimate. It's historically over time of owning the property, 5%, 5 to 6% is pretty common. There's going to be months that you go, you might go 3, 4, 5 months without getting a call or getting anything from your properties, and then you might go 2 months where you got $600-700 here and $500 here, but over the long term, we estimate about 5% of gross rents is going to be dedicated to repair and maintenance. Water, sewer, gas, trash, anywhere from 45 to 55 bucks a unit for water, sewer, trash. A lot of times those are the owner's responsibilities. It's not something that is typically split on a property ever. So you can bill back for that if you want, but it is going to be on your expense line and responsible for the responsibility of the owner. If there's any electric, gas, or common areas that you've got to account for, and most of our properties here in Minnesota, the electric is almost all the time it's split. The gas is split about 50% of the time, and then water and sewer trash, like I said, is never usually split ever. But regardless, if you're paying for any of those expenses, you can always bill them back to the tenants, or if they're separated, you can have the tenants put them in your name or in their name. Sorry. If there's any HOA, if you got to account for lawn and snow removal, if you're not going to have your tenants do it, pest control, things along those lines. Depending on where the property is, 25 bucks a month for pest control might not be a bad thing, or depending on the condition of the property. And then obviously HOA, lawn and snow, if you need it. A lot of times leases will have it written in where the tenants are responsible for the lawn and snow, and you're just giving them a discount on the rent for doing that. Property management, I got it pegged in here at 6%. I would say underwrite with your property management in there, regardless if you plan on managing your property or not. If you're planning on managing your property, just make sure it pencils out with it, because a year or two down the road, you might not want to manage that property, or maybe even months down the road. And you just want to make sure that your deal is not now losing money, that you got to come up for property management. All right, so with all that, like I said, you got your income up here. You've got your expenses down here. And then we go to the debt side. So what's your rate? If you've talked to a lender, you should be able to get an idea of what your rate's going to be. A lot of times is amortized over a 30-year period. If you are doing commercial and it's a 25-year AM, of course you just need to change that, because that's going to change your debt payment or your loan payment. And then if you are going in for 3.5% or 5% down, you need to add your PMI to make sure that you're getting the full picture of what you're going to pay for. And then it brings you down to your KPIs. So what is your monthly cash flow, dollar-wise? What is your annualized cash flow? What's your cash on cash? So this is one of the biggest KPIs that people look at when you're analyzing investment property. So this is what is your total out-of-pocket cost. So all of your down payment, your closing costs, your renovations, and then from a percentage base, what is that compared to what you're getting in a dollar per annualized dollar cash flow? So if that makes sense. So if you put $100,000 in and you're cash flowing $10,000 a year, you'd have a 10% cash on cash. And then, as we know, there's a lot of different ways to make money in real estate. Cash flow is one of them. Principal pay down is another one. And your appreciation is another one. So this calculates what is your annual principal pay down. So you got tenants that are in the property now. they're paying your mortgage for you, obviously. So you got to account for how much they're paying that principal down, which is increasing your net worth and your profitability in the property. And then annual appreciation, we peg this at 3% per year. If any of you guys follow the market, you know that since about 2000, we've been at a little over 4% annual appreciation in our market here in the Twin Cities. Over the last 50 years, nationwide, it's probably close to 5.1 is some of the reports that I've seen. But to be safe, the 3% appreciation, pretty steady idea, just account for it here. So if you take all those numbers and combine it, your cash flow, your principal pay down, and your appreciation, it spits out a total return down here. So 23.77% on this property. Total return if you're including your cash flow, principal pay down, and appreciation. The only thing this really doesn't account for is tax benefits. Mostly because tax benefits, yes, real estate is one of the best investment vehicles to help you from a tax perspective, but how much you can use that is very specific on how you make your money. So everybody's tax situation, how much they can apply from a tax savings real estate strategy is very different from person to person. So I decided not to try to even calculate that in this one. All right, lots of information. Hopefully that helps and gives you a quick rundown on this calculator. If you don't have this calculator already, if I haven't sent it to you, reach out mikemoe at kw.com, mikemoe at kw.com, and I can send that to you. If you have any questions on how to project rents and how to estimate expenses and really anything on this, feel free to reach out. This is something I help my clients with day in and day out. And it's something that obviously as an investor myself, I do very regularly. If you are looking at larger properties that maybe are commercial properties, 5, 10, 15, 25, 35 and up, multifamily properties, you're probably not going to use this calculator. You're going to use a calculator that is a little bit more geared for those investments, which I also have and have experience running as well, since I own some of those size properties as well. So I can happily run you guys through that as well. So hopefully this was helpful. Appreciate it.